What's up, guys? Brandon Lenhoff here. Today, we're going to look at, does it make sense to put more money towards your mortgage every month or buy yourself an IUL policy? Let's take a look. All right, guys. So does it make more sense to put extra money towards your mortgage every month, or does it make more sense to take that same amount of money and put it towards an IUL policy? So this is a common question that we get. We get a lot of people talking about, hey, why don't I put extra money towards my mortgage? I can pay it off faster. Well, let's take this example here. Let's say you've got a $300,000 mortgage and you've got a 30-year term. And let's say you got a 3.5% interest rate on your mortgage. And let's say you're putting $349.35 towards your mortgage extra every single month. Why did I come up with that weird number? You'll see here in a little bit. It's actually the exact amount of money that we would be putting towards the IUL. I'll explain why it will be that weird amount here in a little bit. But if we put that extra $349.35 every month towards this same mortgage, and we start that on April of 2022, you will pay your mortgage off, a 30-year mortgage, by January of 2043. So we're talking, what, about 21 years that we're going to pay this off. So not bad, but what happens if you're married? What if you pass away and you lose an income, your spouse loses an income, or your kids, they lose out on your income and the extra support that you're going to be able to give to them? What would happen? I mean, when you're putting that extra $349.35 per month into your mortgage, it is getting stuck inside of your mortgage. If you pass away, there's no way to access that without selling the house or refinancing it. So why don't we look at if we were to take that same amount and put it into an IUL policy? So an index universal life policy, first of all, what is it? What an indexed universal life policy is it's a form of a permanent life insurance policy. With a permanent life insurance policy, we've got several different options out there. We've got whole life, we've got regular universal life, we've got participating whole life, we've got variable universal life, we've got index universal life. Index universal life is actually one of my favorites. And here's how it works. First of all, the IRS puts limits on how much we can contribute to a life insurance policy and still consider it life insurance and not an investment. It's based on IRS code 7702. So what they're going to do is they are going to limit how much you can contribute based on a death benefit and your age and your health. There's going to be a certain maximum premium you can put in. So the IRS maximum premium that we can put in on this policy, and we ran this on an individual, a male, age 30, standard non-tobacco rating. For a $300,000 life insurance policy, we're looking at $349.35 is the maximum the IRS will allow you to contribute into a life policy. Now, why would you want to put more into a life insurance policy than you have to? Well, with an index universal life, what's cool about how they work, there's a minimum cost of insurance. Then the excess premium is going to go into a cash account that's going to participate in portions of the gains of the market in exchange. So you're not going to get 100% of the upswing of the market, but in exchange, you're never going to have any losses. So with that, your cash value is going to grow inside of the policy. And with that comes a lot of great tax advantages to it. But the good thing for your family is, number one, if we're looking at a $300,000 policy on a $300,000 mortgage, first of all, if you pass away in the early years, we're going to pay off 100% of that mortgage. The further along that you go, obviously, we're going to be able to pay off more than that mortgage and leave a little extra to your family as well. Also, if you were to get sick, so if you have a terminal illness, which would be the presence of an illness or condition where life isn't expected to exceed 12 months. So basically you're diagnosed with something where you're going to pass away within a year. In this example, you have access to $225,000 of that death benefit. So you can accelerate up 75% of your death benefit, and it's a guaranteed lump sum amount for qualifying conditions. If you have a chronic illness, so the inability to perform at least 2 activities of daily living for at least 90 days. So as an example, let's say you cannot dress yourself or feed yourself. It's been 90 days, doesn't look like it's going to get better. You can accelerate 50% of your death benefit, or $150,000 that is available to you. Critical illness, the presence of any of these diseases, or maybe paralysis of 2 or more limbs, major burns, coma, anything like that happens to you, you will have $75,000 available to you, or 25% of the death benefit that you can accelerate. So gives your family a little extra peace of mind if something were to happen to you early on in that mortgage, and maybe it makes it so you can't work, or you have a big medical bill that you're just not going to be able to pay for. Well, you can accelerate this death benefit if you would like to. The next piece, this particular product with one of my favorite companies that we work with, they have a guaranteed lifetime income rider on their product as well. So what this is saying, and they illustrate this at a pretty conservative rate, they're saying based on $349.35 per month, hypothetically at a 5.75% average annual rate of return, and I'll show you the 20-year history tables on this product a little bit later, but they are assuming you would have at age 67, $444,000 of death or cash value inside of your policy. Again, that is based off that 5.75% average annual rate of return. Age 67 is just an age I selected. It's an average retirement age. We can plug whatever age that you would like into this policy in this illustration to show you how it would work for you. But based on this, based on the $444,000 of cash value, they are saying that you would be guaranteed. Oops, sorry about that here. Let me remove that. $2,482 per month, tax-free, guaranteed for the rest of your life, even if you completely run out of the $444,000 of cash. So sometimes people like to have that peace of mind knowing, hey, I want to know I have income for the rest of my life. You can utilize this. So far, versus putting the extra money towards your mortgage, we're already looking at a death benefit that could pay out to you, some living benefits that can pay out to you if you were to get sick or hurt early on in your mortgage or early on in your life. And then also later on in your life, we're showing you how you can turn this extra payment that you would maybe be putting towards your mortgage and getting that payment stuck into your mortgage. You're not going to have any other benefit for the rest of your life, even once you pay off your mortgage. We're showing you here that you can turn around, and once you pay off your mortgage, you can actually start paying yourself. And it's going to be tax-free income. That's huge. It's not even reportable to the IRS. Now, let me show you this as well. I'm going to go down to the illustration portion. So whenever you're looking at these policies, you're always going to see a guaranteed policy value. Every insurance company has to show worst case scenario. Worst case scenario is the market goes down every year for the rest of your life, never comes back up. That's what this bucket is showing, and this rate of return is showing. The alternate scale with this particular company, it is 3.75%. That is their fixed bucket. So we have several different buckets we can put our money into. The fixed bucket pays 3.75% right now for this company. Then we have the non-guaranteed policy values. This is what I was telling you about that we illustrated this policy at and these returns at, and that was 5.75% average annual rate of return. I'll show you the 20-year history tables a little bit later. This is fairly conservative, but want to be realistic with you as well. So you can see your account value, how it grows over time. Then let's go 21 years out. Let's see how much cash that you may have in your policy 21 years from now. It's $132,000. Let's go back to bank rate. let's get rid of this extra monthly payment, because now you're not going to put it towards your mortgage. You're going to put it in the IUL. And let's look at April or January of 2043. It's showing you have $126,000 that you would owe on your mortgage. But 21 years from now, inside your policy, you have 132,000. So if you'd like, you could take this money out and you could pay your mortgage off at that time. Now, since you will have only put about $84,000 worth of premium in, if you cash out your policy 100%, you will pay some taxes on the growth. It is tax deferred. And if you cash all your money out, you will pay taxes on what you pay above and beyond the of what you earn above and beyond your cost basis. But if you don't take your cash out and you take it out in the form of loans, like I was telling you earlier, we can actually turn that into a guaranteed lifetime income stream. And there's several different ways that we can set that up, and you can start to have tax-free income in retirement as well. So does it make more sense to put $350 a month towards your mortgage every month, or does it make more sense to put it towards something that you get a benefit, you get protection, and your family's protected, you're protected, and we can actually turn that into retirement income? You be the judge. If you'd like to learn more, if you'd like one of our specialists to reach out to you and have a illustration ran specific to your unique situation, go ahead and click the link below, schedule a call with us. One of our intake specialists will do a financial inventory with you to get a better idea of where you're at right now, what your goals are. Then after that, either myself or a member of my team will reach out to you and go over the illustrations that will be best for your situation. Talk to you soon.